Joining us now, former Council of Economic Advisors, Acting Chair Tom Philipson. Tom, thanks for joining us.
Good to be with you guys.
So good to hear that the tariffs are paused, but big picture, wouldn't it be better if the president would just focus on getting countries, like a lot of countries in Europe, like Canada, to pay for the drugs they consume instead of finding ways to rip off our producers? I know you've studied this a lot, looking at the pricing in different countries.
Yeah, I mean, the brand prices are higher in the U.S., about 3 times higher than other countries. But we have lower generic prices, which is 93% of prescriptions. So if you look at average prescriptions, they're actually cheaper in the U.S. than they are in Europe. So if we approached the free riding on providing for medical innovation with Europe in a NATO way, where we basically required a certain part of GDP to be spent on innovator drugs, they could actually lower their total drug spending, because if they just got more competitive generic markets like we have, that's by far the biggest chunk of prescriptions, and they would save a lot more than the increase in promoting innovation through higher brand prices.
So President Trump needs to have I was going to say come to Jesus moment, but I will say a get with the program discussion with all of these nations about how to lower your drug cost overall, but paying more for our premium, high-end name brand pharmaceuticals. But I want to move on to this, because this is about tariffs and the trade fight. President Trump is looking at a potential $10 billion in a bailout, a handout, whatever you want to call it, for U.S. farmers. This is related to China has completely cut off buying soybeans from U.S. farmers. Soybeans, it's about almost $13 billion a year. And this started back in 2018. So when you were in the first Trump administration, $30 billion a month is what's coming in tariff revenues so far. How do you see this? Because this is only a temporary fix, Tom.
Yeah, and it's a little deja vu, essentially, from the first administration, where soybeans were about 70% of the loss the farmers took. It was a big deal. And China now have cut the demand for their soybeans by about 80%, roughly, compared to last year. So it's a big deal. We handed out $23 billion at the time in the first administration. Now they're talking about $10 billion roughly. And I mean, it's China, right? So we don't want to have free trade is different when you talk about China, because free trade with China builds their economy and therefore their military, which is adverse to ours, obviously. So I'm for free trade. I'm not for free trade when it builds up a military that wants to go after us. And so I think there's sort of this patchwork going on when we're dealing with China, which wouldn't be justified for other countries, but I think can be justified for China.
Right.
Okay, so maybe this should be rightly seen as a national security expense, not a cost of economic regulation so much.
Exactly.
Okay.
That's how I see it.
Tom, we wanted to hit one more, and that was we were fortunate to publish your comments in the Journal recently on this nutty idea of taxing patents. And you've been trying to point out to people that if you want taxpayers to get a return on innovation, they're already getting a much bigger one than taxing patents.
Yeah, exactly. I mean, Lutnick wanted to tax a 50% tax on patent, which is a crazy idea for many reasons. But his thinking is sort of, government hands out $50 billion as an early investor in these patents, if you want to think of it that way. Shouldn't they therefore get a share of earnings like any investor? The problem is that the professors who basically invent these patents at the universities where they're handing out money, they pay a 37% income tax on any earnings from the patent. So that goes back to the earlier investor, i.e. the government. The tax-exempt universities, even though they don't pay taxes, they get hurt because the companies that get started from these patents pay taxes, either capital gains or corporate taxes, which then funnels down less to the universities. But most importantly, future shareholders in these companies, if you think of government as a shareholder, gets taxed by the government, income, corporate, and capital gains essentially, and no early investor in the private sector gets to tax future investors into that company. So the government is really getting a great deal in terms of getting a share of earnings from initiating patents.
Really quickly before we go, it seems like Howard Lutnick is doing things that he's kind of the architect of some of this. Let's take stakes in some of these private companies, and what is he up to? Because it seems like a lot of bad ideas.
Yeah, I mean, it's scary because if it transfers over to a Democratic president, imagine all the damage can be done. I mean, I think they have the right heart, but I don't think the next generation of Democrats would use it the same way. But I think for innovation, I think it's so dangerous because, I mean, innovation is the key to economic growth, to do more, with less, essentially. Right. That's what innovation is. That's what economic growth is. Right. So you're going to overtax innovation. That's just, I think, absurdly destructive.
What I was getting at too is like, look at all the money, making suggestions and saying, oh, look at all the money that we've got coming into the sovereign wealth fund and the coffers, just to curry favor with the big kahuna. Tom Philipson, good to see you, sir. Thank you.
Thank you.